Good afternoon and welcome back, everybody. Happy that you could join us, particularly at a time when we've got such an amount of volatility, peril, a lot of things going on, both in the financial markets as well as politically. The one thing I would warn you all about is this, is that we have had a lot of calls from individual clients who are very, very concerned obviously about the policies of the Trump administration and asking questions as to whether these policies are going to lead to real problems for the economy, real problems for the markets. And emotionally, they're very, very caught up in this. And in some cases, they even want to significantly reduce their allocation or the percentage of their portfolios in equities. The one thing that I would warn everybody about, and including myself, is that it's very easy to be caught up in what's going on politically, emotionally. And the one mistake you can make in this business that I've learned over the years is that to make decisions when you're caught up emotionally in what's going on tends to be a mistake. You can't make a decision on the basis of your emotional reaction or response to public policy or anything else for that matter. You try to be as objective and as cold-blooded as you possibly can. I know that sounds heartless, but you need to be very cold-blooded in making good investment decisions. Those are the best decisions that are made. That's why we at Hugh Johnson Advisors have spent so much time over the years developing what we take to be disciplines, very, very clear, objective disciplines on making those important decisions with regard to portfolios, asset allocation, or the percentage of a portfolio that's going to be invested in stocks, the percentage invested in bonds, and details of a portfolio, such as what we're going to have, what sectors of the market are we going to overweight, which are we going to underweight, are we going to emphasize large companies or small companies, and even in the bond portfolio, what's going to be its technical duration of a bond portfolio, and are we going to emphasize longer-term bonds or shorter-term bonds. These are all kinds of decisions we make, but we make them on the basis of a very, very disciplined an approach, a methodology, if you may, that we've developed over time. That methodology really consists of two parts: financial markets. We look at the financial markets, and the performance of the financial markets tells us whether we should be overweighted in equities or underweighted in equities. The message of the markets, we often call it. That's part of the looking at the financial markets. And then we also look very carefully at lots and lots of monetary and economic variables. Say, for example, the index of leading economic indicators, which has happily increased in 6 of the last 7 months. It's on the basis of kind of an objective, hard look at the financial market performance, as well as to look for confirmation in economic and monetary variables. That's kind of our approach in making some of these decisions. It's not as though the decisions are completely quantified or completely objective. We do use some judgment, but we try to reduce that judgment to make sure that we don't allow our own emotions to enter into the decision-making process. So in answer to that question about is this the end of the bull market and the start of a bear market that will be accompanied by an economic recession, are the Trump policies that we're seeing in Washington, which can stir the emotions in all of us, are those policies going to lead to real problems for the U.S. economy, both the domestic economy as the U.S. economy as it tries to operate or work or become successful in this world of ours? And the answer right now is that the financial market performance is telling us, no, this is not the end of the cycle. The bull market is not over. It's also, we look at the economic and monetary variables, they're also confirming that, saying that indeed it's not the case that we're at the end of the current bull market economic cycle, even though this one has been very long when compared to other cycles in the post-war period. But we're not at the end. So that's not the problem, and I wouldn't get caught up emotionally in all of the kind of political turmoil that you do see that, again, does generate all those very, very strong emotions. That doesn't mean everything is really good. The one thing that I've mentioned before, and I'm still going to mention it, is that we have a valuation problem. The stock market, as everybody knows, has gone up very far, very fast since the election, 8.5%. under any conditions. That's a very, very strong and a very fast move up in stock prices. And it's reached a level which, as we crunch the numbers, as we quantify the current levels of the markets right now, we would say we're probably 5 to 6% overvalued. So even though we're a little bit pricey overvalued, we're not anxious to increase our allocation to equities. We would only do that if we saw significant, and I mean significant, weakness in the market for whatever reason that might develop. How much? 5 to 6%, that might do it. And then we'd start to take a look at the market very carefully, and we'd be looking for those kinds of values in individual stocks that would represent pretty good buys for your portfolio and hopefully provide us with the kinds of returns that we really would like to generate in 2017 and in 2018. So again, it's not the end of the current cycle. Don't get caught up in the emotions, which is easy to do right now. It's easy for me to do. Try to follow some disciplined, objective approaches to the markets, which we're trying to do. And based on that, we'd say we've got further to go in the current cycle, and it's not time to significantly reduce equity exposure. You may have questions. There are lots of things going on in this world of ours. The dollar, that's a very important. What's going on in Europe? What's going on in the Far East? All of the political issues. We'd be happy to talk to you about them and tell you exactly how we reach our conclusions. We welcome your call. I welcome your call. Love to talk to you at any time. And that's the way we look to it now. You know, we had a really successful 2016, crossing our fingers for a good 2017. I don't think it's going to be as good as 2016, but I didn't think 2016 was going to be anywhere near as good as it turned out to be. So let's keep our fingers crossed. Let's hope we have a good 2017. It looks like things are going to be okay, and we'll keep you informed by bringing you up to date every month or even sooner, more frequently, on our Market Minute. Thanks very much for your confidence you're showing, and I look forward to either talking to you or certainly talking to you through the Market Minute in a month's time. Thanks very much again.